Yeah, going into this weekend, there were three types of economic forecasters. Those who had no, some, or total faith in the ability of Washington politicians to deliver new COVID relief to American families. Well, the doubters, a bit like stock investors this morning, find themselves needing to upgrade their forecasts, and they now see better, though not stunning, first quarter growth after the president signed that $900 billion COVID relief bill last night. Goldman Sachs writing in a report, quote, "The biggest difference relative to our prior assumption is the inclusion of stimulus checks, which now imply a large increase in disposable income in Q1." And you can bet they'll be spending that. Goldman upped its first quarter growth forecast to 5% from 3%. Michael Gapin of Barclays told me this morning that he had not yet put pen to paper for his forecast, but expects to upgrade his Q1 outlook, which currently calls for flat growth. He said, and I quote this morning, "The relief is a little larger and a little sooner than we had forecast, so there's some upside for Q1. If rebate checks go out soon, they will be spent, so will extended unemployment benefits." The relief comes too late to help December employment. The average forecast is for job growth of just 100,000, with several forecasters flat or even negative. And it won't help December retail, though there have been a few positive reports following that consumer spending decline we saw in November. Overall, it's positive for the outlook that the relief bill is now done, but the delay inflicted avoidable pain on many individuals and the broader economy near term. And it looks, folks, like maybe the market needs to catch up with, along with the forecasters this morning, David.
Yeah.
I just have a question, Steve.
Go ahead, Sarah.
We were debating some of the risks. No, I was just going to ask Steve about what it all means for the Fed. We were debating some of the risks for 2021. And one of them is that growth is so good and so strong because of the vaccines and the stimulus and the pent-up demand and everything else that we talk about, the reason the markets rallied. How long is the Federal Reserve going to be able to stay at zero rates, they say, until 2023 and keep buying over $100 billion in purchases to stimulate the economy if we're printing 5% GDP numbers?
Sarah, I don't like to correct you nationally on television here, but it's $120 billion. Of course, what's $20 billion of extra asset purchases among friends, you know? And I'm only making light of this to make a point, which is that it's a lot. I think that'll be the first to go. I think there is possibility that in 2021, this is a sort of out there forecast that they're not out there, that there is some decline or announced taper by the Federal Reserve in asset purchases. I think under the scenario that you lay out, which, you know, thank God for high-class problems like too much growth if we get there, the Fed will announce some form of decline or tapering off of asset purchases. I still think rate increases are a long way off, 2022 at the earliest. I think the Fed's going to try to hold the line for longer than that. I think, Sarah, if you think about it, all the Fed is doing right now and still below 2% inflation, it suggests to me there are strong deflationary forces out there in not just the U.S., but the global economy.
Shepard Smith here. Thanks for watching CNBC on YouTube.